Hello, my name is Paul Wallace. I'm the Africa editor at The Banker, and I'm here in Washington with Sim Tshabalala, co-CEO of Standard Bank. Sim, thanks very much for joining us. In the meetings that you've attended and the events that you've been to, what have been the main themes that you've picked up on?
Well, first of all, there have been lots of questions and conversations and comments about the sort of the situation that America finds itself in right now with the government shutdown. Secondly, there have been lots of questions around emerging markets, in particular sub-Saharan Africa. The third set of themes have revolved around the fact that America really is in its fourth year of growth, actually, and that it'll be growing at 2 to 3% for the next while, which is good, I guess, for the global economy. Interestingly, there's been lots of conversation about Japan and the potential growth coming out of Japan. And then, of course, there have been conversations about the resilience of the banking system and then where to regulation.
Has there been much talk about quantitative easing and the effect to slow down, the effect tapering might have on African economies, and particularly the big ones like South Africa?
Yes, the big question has obviously been the impact that quantitative easing and the slowdown thereof has on emerging markets has been a big topic. We saw what happened in the last couple of months with the flight from emerging markets, and obviously everybody worries about the impact that would have on South Africa and the rand.
Just turning to Standard Bank and the banking environment in Africa at the moment. South Africa is an economy that's growing at about 2% at the moment, which concerns many economists. Is that rate of growth something that's hurting the banking industry, or do you still see plenty of opportunities in South Africa?
2% growth is not fast enough for our liking, but you can see a potential outcome that looks something like this. South Africa gets back to trend growth as the global economy recovers, so it ends up at 3.5%. Policy rationality prevails in South Africa. Institutions get strengthened, you add another 1%. There's oil and gas having been discovered on the east and west coast. That opportunity gets exploited. There's fracking. That opportunity also gets exploited. The infrastructure continues to be built. The 827 billion rand in South Africa gets spent. So the transport, the power infrastructure gets refurbished and rebuilt. And all of a sudden, South Africa is a fast-growing nation with shared growth.
So there's still opportunities in the country for Standard Bank.
My point is exactly that there is enormous opportunity for growth if one looks beyond the short term.
Standard Bank has been increasing its presence in the rest of sub-Saharan Africa quite a bit in the last few years. You're present in many countries on the continent, but let's say for the next 5 years, what is your strategy for sub-Saharan Africa, excluding South Africa?
I guess, Paul, the strategy is, maybe let's split it into two. As far as the retail bank goes, we see increased disposable income, a better qualified and a healthier and a longer living middle class. Therefore, they've got more money to spend, and therefore the retail bank is calculated to do well. We'll be making sure that our distribution channels are appropriate given the modernization that is happening in Africa. The branch network, together with mobile, together with the web, together with internet, will integrate in a sophisticated way to deliver a sophisticated set of products and services for our retail customers. On the corporate side, as I indicated earlier on, as the infrastructure gets built, there's greater corporate activity. We are going to be positioning ourselves to facilitate the delivery of that infrastructure. But importantly, we see increased movement of capital, goods, and people between Africans and also between African countries and Europe, the Americas, and the Far East. We're positioning ourselves to facilitate the movement of that capital, people, and goods.
Standard Bank announced recently that it was going to open up representative offices in Abidjan in Cote d'Ivoire and in Addis Ababa in Ethiopia. Does that signal an intent on the part of the bank to push aggressively into Francophone West Africa and into Ethiopia once foreign banks are allowed into the country, or will you do you see yourself sticking with rep offices and for the medium term at least?
Well, we're going to be following economic activity, so we will open those rep offices and participate in the flows that happen. The use of our resources to grow aggressively, I don't think the growth will be aggressive, but will be modest and will follow the activity of our clients.
Sim, thanks very much for joining us.